What's up, world? This is Serge W.D. Haiti with Serge W.D. Haiti, CPA PLLC, and I'm the dreaded CPA, where life is good and living is better. So in today's video, I'm going to be going over the income tax formula for trusts and estates and wealth transfer taxes. The tax formula, income tax formula, is similar to individuals where you have gross income, deductions to arrive at taxable income, TI. So it's pretty similar to individuals, but the only difference is it depends on what you are reporting, either a trust or the different type of trust that you have or an estate. So you have income in respect to a decedent, and this income is for estates where the individual that died still has money out there that's waiting to be received, but hasn't been in they haven't constructively received it from whoever they had a contract with. For example, you may have an individual that was working as a CEO of an organization and they were due some money for their services, so they haven't received it before they died. So that's income in respect to a decedent. Or you have an individual, I'm gonna use Michael Jackson as an example. He has a whole bunch of royalty income that's out there that's floating from all the record sales that he has, or even lawsuits that's pending. So when he finally wins that judgment for those lawsuits, that it would be considered income in respect to a decedent. And those are taxable to the estate. The capital gains from the sale of the principal that's inside of the trust will be included in income for the estate or trust. And then there's adjustments that's made to the income, which applies to both the trust and estate. However, there aren't any standard deductions in the trust or estates. And with the deductions, these reduces the gross income. The most common ones are trustee fees or the estate fees, the administrative fees, tax planning and preparation fees, which would be where I fit into this formula. And these are fully deductible by the trust or the estate. You have depreciation charges that goes against the income, and this is based off of however the trustor or the individual that's created the estate wanted these assets to be depreciated. So it has to be in compliance with the legal document that is set up by the attorney for the estate and trust. Trust and estates, they are allowed net operating losses. Capital losses are offset against capital gains plus $3,000. Charitable deductions are allowed only if there are not simple trusts. As I said in the previous video, a simple trust cannot make charitable deductions, hold charitable deductions. They only can use current income to pay out current distributions to the beneficiaries of the trust or the simple trust. Tax exempt income is not allowed for a deduction in a estate or trust. And also the passive activity losses are not used to be offset against any portfolio income. They are treated separately and unique to themselves. And this is just a quick run through of the income tax formula for estates and trusts. In my next video, I will go into the different items and go into details a little bit more. If you have any questions or comments or concerns, you can leave them in the comment section and I will get back to you shortly. So this is Serge W.D. Haiti as the dreaded CPA of Serge W.D. Haiti, CPA PLLC, where life is good and living is better. Have a great day.